They tried to tell you Bitcoin was digital gold. They wanted you to believe the old system could simply tokenize its problems. But as gold itself surges, a new truth is emerging. XRP is revealing its true nature. While politicians in the Senate Agriculture Committee try to outlaw passive yield on stable coins, effectively telling you to use their credit cards instead of earning interest, the global financial elite are quietly laying down 110 million in tokenized diamonds on the XRP ledger. Tonight, we expose the real reason behind Washington's ethics gap, the hidden truth behind David Schwartz's unlikely $100 price comment, and why IBM just signaled the biggest shift in finance with XRP as its Tier 1 blockchain. The digital gold rush is here, and this time, the banks can't stop it. Welcome back. I am the calm analyst. Let's address the core of the issue, the great decoupling. As we enter February 2026, investors are witnessing a historic divergence. Gold has broken through $5,300, solidifying its role as the bunker for wealth. But look at the narrative shifting toward XRP. Institutional observers are no longer calling it a payment token. They are calling it a gold-like risk asset. Why the comparison? Because in this era of fiscal instability, investors are hunting for low counterparty risk. XRP exhibits cash-like properties that even Bitcoin struggles to maintain at scale. High liquidity, non-S sovereign control, and the ability to move any amount of value globally in seconds, while Bitcoin is being treated as a liquidity sponge, moving with the expansion of the money supply. XRP is being positioned as the infrastructure of value. But here is where it gets tactical. The banks aren't just watching from the sidelines. They are rewriting the rules to protect their deposits. The Senate Agriculture Committee just advanced a market structure bill that contains a massive blow to retail crypto holders. They have successfully pushed for a ban on passive yield. Under the proposed 2026 guidelines, if you deposit $10,000 in USDC and let it sit to earn 5% interest, Washington says no. The banks argued that earning interest on a deposit is a privilege reserved exclusively for banking institutions. They are effectively killing the crypto savings account. So, what is their new plan? A pivot to the credit card model instead of earning interest on idle cash platform, who will be forced to offer activity-linked incentives and done. You earn only when you spend. You earn only when you move value. The banks don't want you to be your own bank. They want to force your liquidity back into the transactional machine where they can collect fees. This is why they fear XRP. XRP doesn't need a bank to create yield. Its value comes from its utility. If you can move millions in tokenized diamonds or gold across the XRP ledger for a fraction of a cent, you have effectively bypassed the entire legacy interest trap. The institutions are choosing XRP because it is the only clean bridge left that can scale while the Senate bickers over who gets to hold the savings crown. But while the banks win the battle over interest, they are losing the war over clarity. Why is the Clarity Act still stalled in the Senate? And what does the ethics gap involving the Trump family's latest crypto ventures have to do with your XRP bag? Potentially hitting 98 before it hits $27. If you want to understand the price, you must understand the politics of delay. As we sit here in early February 2026, the Clarity Act, the bill we were told would save the U.S. crypto market, is currently gasping for air in the Senate. Why? It's not just about rules, it's about the ethics gap. Senate Democrats are refusing to move forward until strict bans on digital asset trading are imposed on elected officials and their families. They are specifically eyeing the Trump family's recent ventures into DeFi and stablecoins. This political tug-of-war has created a vacuum, and in a market that hates uncertainty, vacuum leads to volatility. If the president's family hadn't entered the crypto arena before the rules were set, we might already be at the finish line. But instead, we are in a wait-and-see purgatory. Let's look at the charts through the eyes of Paul Barron. If the Clarity Act continues to stall and the Fed remains spooked by core inflation data, the technicals are flashing a warning, a death cross formation. A failure to reclaim A180 quickly could open the trap door to A1.25 or even the psychological floor of 98. I know what you're thinking, not again. But listen closely. If XRP falls to 98 cents, as Paul Barron says, the truck is backing up. The 1% want you to panic sell at 98 cents because they know the institutional inflows tell a different story. Despite the price drop, XRP ETFs in the US, Europe, and Asia are seeing record inflows. Over $1.44 billion has flooded into XRP ETFs in early 2026 alone. The institutions are treating XRP as a structural hedge. They are buying while you are crying, while retail is staring at the death cross ... The 1% are looking at the Japan, UK, and EU regulations that are already moving forward without the United States. XRP is fundamentally stronger in 2026 than it has ever been, but the macro headwinds are a different beast. Are you looking for the exit door? Or are you preparing your truck for the $98 opportunity? Because one way or another, XRP is going to pop off, but price is only half the story. While Washington fights over ethics, EBM and DFNS have just officially crowned the XRP ledger as a Tier 1 institutional blockchain. From tokenized diamonds to the secret behind David Schwartz's latest comments, let's see why just payments is now an outdated narrative. If you still think XRP is just for cross-border payments, you are reading an outdated script. The narrative has officially shifted. While retail investors worry about the daily candle, the infrastructure giants are moving in. The news that DFNS has officially partnered with IBM to support the XRP ledger as a Tier 1 blockchain is the loudest signal we've had in years. This isn't just another partnership. This is institutional-grade security meeting global liquidity. IBM is at the core of the new financial system. From its ties to Stellar and Hydera to its deep roots in Ripple, by integrating the XRP ledger into their secure MPC wallet infrastructure, they are giving the green light to every central bank and mega corporation on Earth. The ledger is ready, but they aren't just building, they are tokenizing. Look at the data. $110 million in tokenized diamonds just landed on the XRP ledger. We are seeing real-world commodities, rare high-value assets being fractionalized and traded with the same ease as a text message. 46 million here, 35 million there, 15 million in another collection. This is the playbook. Payments infrastructure first, tokenized assets second, full institutional financial rails third. XRP settles it all. Whether it's gold, diamonds, or real estate, XRP is the oil that makes these tokenized gears turn. Now, let's address the noise on social media regarding David Schwartz. The critics want you to believe that even the CTO of Ripple has lost faith because he said $100 feels unlikely or ridiculous today. But they have no memory. In 2017, when XRP was at half a cent, the idea of it hitting 25 cents felt just as ridiculous. Yet, it didn't just hit 25. It rocketed to $3.84. David isn't saying $100 is mathematically impossible. He is acknowledging the current market sentiment. But as we saw in the past, XRP loves to pull a shocker. And for those who say ISO 2022 is no big deal, look at the Flare network anchors. Every payment on the XRP ledger can now be converted into a structured ISO 2022 receipt. This means XRP is now speaking the same language as the global banking elite. Point 2. From Web3 apps to legacy Web2 banks, the bridge is built. Point 2. Ripple doesn't need to win every court case for the ledger to succeed. Point 2. Even if Ripple disappeared tomorrow, the XRP ledger is a borderless, neutral, next-generation machine that closes blocks every 3 to 4 seconds. It doesn't care about the price. It only cares about efficiency. Stay patient. Stay positive. Because while the retail crowd sells their diamonds for pennies, the institutions are building a world made of them. In a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss while calm analysis leads to victory. Thank you for your trust and thank you for being part of this rational community. I am the calm analyst. Stay patient, stay rational. And as we always do, we don't wait for the future, we plan for it.